Warren William here, Smartest Data, quick definitions. Illiquid stocks. Why do some stocks become illiquid? How to identify illiquid stocks in investing in the stock market. Let's go to the video and look into issues surrounding illiquid stocks, define, explain, and at the end there'll be 3 bullet points to take away. Illiquid stocks cannot easily be sold on the exchange. Market cap is an indication. Nano cap or microcap stocks, volume, free float, and price spread are also factors. Also, limited investor interest could be an issue. A stock's level of liquidity is one factor often overlooked by stock investors at the point of investing. In monitoring a stock holding, often only discovered at the point of attempting to sell the stock. The potential for a stock to become illiquid is a major risk to the share price and is exacerbated as the share price falls. Illiquid stocks are generally thought of or classified in terms of size of their market cap, so nanocap, penny and microcap stocks, and certainly this is a good place to start. When stocks become illiquid, they cannot easily be traded in the stock market, thus carry a greater risk in their stock price. Why or how stocks become illiquid is more nuanced than simply looking at market cap. Any stock, independent of market cap, can become illiquid. The reality is that in the worst case scenario, a stock can become illiquid due to limited interest by other investors. Apart from limited investor interest, the level of volume traded is key to identifying illiquid stocks. Therefore, as part of the analysis, a clear understanding of the following 3 points is critical. First, the level of volume traded as a percentage of market cap, which can be assessed by analysing the very recent volume compared to the average daily volume traded calculated over the past 3 months. Understand the percentage volume traded compared to other stocks with similar market cap and the recent trend. If decreasing in volume, this is a concern. Second, the percentage free float, which is simply the amount in percent of the stock's market cap which is freely floated on the stock market. The free float is the shares not held by management or insiders. For example, in the January 2021 trading of GameStop, the short position was 130% of market cap. I believe around 14% of GameStop shares were held by the new management. Thus, the short position of the actual free float was 50%, further impairing the fund's ability to cover their short position. Somewhat subjective, but be aware if the free float is lower than 50%, this is a concern. Third, the bid-ask spread must be taken into consideration. For stocks with a high volume, the bid-ask spread should or will be narrow. Then if the spread between the bid-ask prices is wide or starting to widen and the price volatility is increasing, this is also a concern. A quick way to assess if the bid-ask spread is wide is to look at the range of daily price movements from high to low and if the bid offered keeps dropping. Avoid illiquid stocks and monitor the liquidity trends of stock positions currently held, in particular for stocks classified as nano, penny or microcap stocks. Three takeaway bullet points regarding illiquid stocks. Market cap is important, but not the only issue. Volume, market cap, free float percent, and bid-ask spread are also aspects to monitor. Monitor the liquidity of stocks. Avoid illiquid stocks at all costs.